Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment. We're on a mission to become Australia's most trusted property podcast. I'm joined by Chris Bates. Chris, how's it going?
Things are good, Pete. How have you been?
Mate, I've been really good. I've actually, if I look a bit tired this week, I've been camping with the kids for 4 or 5 days at a festival. So, yes, it's nice to get back into your own bed after a few days camping, as you well know. But it was a really good event, very family friendly. Kids enjoyed it. How's your week been?
Yeah, I think that's something we'll probably do when the kids get a bit bigger as well, right? It's such a good environment for them to, make friends and experience life. We're actually up in the Gold Coast for 5 nights. We went to the Rask Roadshow on Wednesday night in Brisbane. So might have met a few people there that are listening today. And then we had a team event in the Gold Coast. We took jet skis out, which was pretty cool. We actually flipped one, which wasn't fun. Took the family to Dreamworld and then just hung out on the Gold Coast. It's such a great place for families, right? And it's just crazy the amount of building that's happening along the beachfront strip. I was blown away with that. We actually climbed the Sky Point Tower right up to the top in harnesses and things like that. So that was good little trip and got some good weather. What's been happening with you, Pete?
Yeah, I've been following some of that building up and down the coast, mainly Sunshine Coast, but also Gold Coast a bit as well. And it seems to me like some of those developments have been under construction forever. I think there's a lot of dwellings under construction, but they're just taking a long time to actually get finished. And there's been project delays, I guess, availability of materials and overruns. So there's still a lot of stock sort of in the pipeline, but it just seems to take so long to get it finished at the moment. So hopefully some of that stock will start to hit the market and ease some of those rental market pressures. There's been a very disrupted 2 or 3 years, I suppose, from that perspective. I think there were some stats out this week, actually, on housing construction. It's still ticking along, but it's just not really keeping pace. There's just so many people moving into the country at the moment. There's a bit to talk about this week. And yes, as Chris mentioned, we've still got a few parts of the Rask Roadshow still to go. So if you're in some of those places where we haven't been yet, Newcastle, Port Macquarie, and also the Sydney event, do try and grab a ticket, and I'll be along to some of those events and see you there. Actually, while I'm on the subject, Chris, on 22nd of September, got a few spare tickets. We're doing a half-day property workshop in Sydney down near Circular Quay. So if you're interested, just shoot me an email. We might just stick a link in the show notes. So we've got a few spare tickets. So listeners to the podcast might want to come along. Just a nice little half-day workshop.
Yeah, absolutely. I'm looking forward to that, Pete. I'm actually speaking at the Pippa conference in the morning, and then we're doing some little masterclass in the afternoon. So that's going to be fun. It's funny you said that around the Gold Coast. When I was looking at all these developments, there was so many marketing, but there wasn't many in the build stage. And the beautiful marketing, right, called Sunrise or Whole Floor, 3-4 bedroom apartments, really targeting that sort of affluent downsizer, a lot of them. And they were basically buying up whole unit blocks too. So they were all boarded up, all ready to go, but they hadn't really commenced. So that sort of aligns, Pete, that they're trying to sell them all first, and maybe they're just delaying the project till the right time to build. So what 3 are we going to cover this week, Pete? Because there's always lots happening. Some good news with inflation this week that while it's only monthly inflation, it's a bit of forecast, isn't it, I believe, rather than the quarterly numbers. But that's all looking good as well. But what are we going to cover this week?
Yeah, I think actually, you're right. I think on those apartments, I think on that story, I think actually at the premium end of the market, there's still some activity, but I think it's very difficult for developers to turn a profit now. And I think we're going to see new unit prices rising over the next few years because the cost of construction is up around 50% for medium density dwellings since 2019. And I just don't see there's going to be enough supply coming through for apartments anyway, unless it's at the premium end of the market where they can make it work. Anyway, the 3 stories we're going to cover this week. So firstly, CoreLogic did a little market update. Eliza Owen, regional markets coming under pressure. That's because of the increase in interest rates, of course. Secondly, the ABS put out a new experimental data series on the number of unused or unutilized dwellings around the country. That's pretty interesting and told a different story from what we normally see in the census. And then thirdly, well, there's a couple of big players in the property industry. They're starting to make noises about APRA's lending assessment buffers and saying they're too high. So ANZ's chief executive and also the CEO or chief executive at Stockland starting to make noises about this. So some of the non-bank lenders are making life a bit easier for borrowers, but not really possible for the deposit-taking institutions. So we'll just talk a little bit about what's going on there as well. So Chris, should we start with the regional market story? So interesting piece. So I guess the general thrust of it is that migration patterns are now normalising. So we did see all this sort of movement outwards during the pandemic as people looked for, I suppose, more space, getting away from those apartment blocks and high-rise towers. But now things are kind of, normalising, getting back to normal. Borders are open again. I see in August, capital city prices re-accelerated up about 1%. So they're close to sort of previous highs in the capital cities, but some regional markets now coming under pressure. And CoreLogic did highlight there some of the markets like Ballarat and Geelong, Southern Highlands. These are all double-digit declines from the highs now. So I guess that speaks to, just a reversal, I think, to some level of the previous migration patterns that we did see during the COVID period, Chris.
Yeah, I think there's a bit of both of decrease in the demand. I mean, it was off the scale in 2021 and 2022, even parts of 2020, late 2020, when people were allowed out of their homes again. We saw, a complete shift in buyers' preferences, really. They were very much wanting to stay close to the capital city and commutable to work because they had to get to the city 5 days too. And we always had conversations of, why don't you consider looking to move to the north of Wollongong or, parts of the Central Coast or, Gold Coast, Sunshine Coast or Geelong, Mornington, etc. And a lot of people would talk about it, they'd consider it, but ultimately they'd go with the safe option, which is staying close to the city. It's just they couldn't justify that commute. Even if they had great flexibility with work, we found there was still a real hesitancy to make the move. That obviously changed in 21, 22. But we've seen a real, that kind of back to pre-COVID, a real desire to stay close to the city and a bit of a concern to make this big lifestyle shift, worried about future employment, worried about flexibility with work and what their options are at different employers. And if anything, they're going with the safer option is what's going to suit them now and their lifestyle today. And rather than making this big lifestyle shift, knowing that they're going to have guaranteed remote work, and it's so that lines up with that. But I also think it's a supply increase. I think, if you talk about somewhere like Ballarat, from what I've seen recently, I think listings have gone up dramatically. And so, people are like, well, actually, it's a great time to take advantage of, a sale price that's much higher than it was just a few years ago. Maybe we should still cash in. And so if you get an increase in supply, and I think that's a similar thing in the Byron region as well. And so, increase in supply and a drop in demand, you do see this pressure on prices, and there's no FOMO in the market in those markets. I'd say absolutely we're seeing after these 2 rate pauses, and to be honest, all the way through 2023, besides May and June, it's been a consistent flow of new buyers entering the market who are taking a long time to buy generally because they've been very patient waiting for something good. And there's just this sort of pent-up demand building. But yeah, that aligns with that. And I think the rental stress down there is not as big as well, Pete. I think, the rental price growth and that pressure to buy straight away isn't there. So if someone's making that lifestyle shift, maybe they're thinking, well, do we just rent up there for a year because we can to see if we really like it, rather than selling up in the city and making the move?
Yes, I think the rental stress, it's going to be an ongoing issue, but I think some of that real jostling to find somewhere to rent is just people are starting to work their way into the new market conditions. There's a few more for lease signs around. Probably not going to see the big increases in rent that we did see over the past year or two. I think, certainly CoreLogic's analysis showed that interest rates have impacted regional Australia pretty hard. On the plus side, as you said, this week the monthly inflation figures came out. Market expectations were for a decline from 5.4 to 5.2%. Actually, quite a significantly better than expected result, 4.9 in the end. And in fact, if you look at that on a 3-month annualized basis, I mean, that's only 2.7%, effectively back in target. Now, of course, things can change. I think electricity prices are still pretty punchy. We've seen fuel prices actually going back up in August, so we're not out of the woods yet. But I think even the Australian, the next day, ran an article saying this is priming Australia for interest rate cuts in 2024. So I think, there are some sort of signs there that we might be getting close to the peak of the interest rate cycle, which would obviously help. Building approvals figures also out this week are slowing around the country. So at least from the construction side, I think things will eventually start to slow off. I think, though, as you said, I think one of the issues is that a lot of the regional markets have had such a good run. And I did see some stats out from PropTrack, nice little graph they put together this week. The number of Australian landlords by age, and just over the past 5 or 6 years, there's been a big surge in the number of over 60 cohort landlords. And I guess a lot of those will say, well, hang on, I've had a 50% boom in prices in some of these regional markets. And some of those will surely be looking to sell, particularly the pre-retirees. It's an ideal opportunity to get out and fund their retirement. So I just wonder whether one of those people who've had a really good run and they're seeing an opportunity to cash in their chips, and I guess that would depress prices over the next year or two.
Yeah, I do think that the premium ends of the regional markets, the good properties, are still going to be hard to find because I do think there's a lot of people leaving the city will go, oh, actually, I will leave because I can get, 600 square meters of north-facing rear land in a great spot in that suburb or right near the beach, etc. So, and I don't think they're likely to sell as much as well. So I think you're still going to find it's hard to find quality in these markets. But you're right, people who are, potentially just want to cash in their chips and that they need that money for their retirement. They never thought their, house on the Central Coast would be worth 1.5 million. And, that's a big chunk of change for their retirement. I would say that, it's not to say the regional markets are over, right? I would say that it's a great time. And a lot of people say that in property, it's a great time to buy. But when you want to buy is when there is a bit of fear in the market, when there isn't this sort of drop in days on market and prices are starting to go up. You sort of want to get ahead of that, right? So I would say as Sydney, or Melbourne or Brisbane, I say people get forced out of the city more and more. They'll naturally go look at these sister cities. So that they will grow after they get pushed out of the city. So, we're seeing some price growth in Brisbane really strong, in Melbourne, in Sydney. As people get forced out of the markets they want to be in, they'll start looking at lifestyle alternatives again. And I think that'll line up with more remote work, flexible work locked in as that battle continues over the next few years. That'll get more and more. I would bet on hybrid work personally. I don't think you're going to bet on 5 days, but I don't think you'd bet on, 0 days in the office. And hybrid work still works in those tier 1, sister cities. And so if that gets locked into the way we're working, and more companies just embrace that, and people are getting forced out of the cities, well, that's going to do really well for these regions again. So, if you are looking at those regions, this is actually better news for you rather than what we saw in 2020 and 2021 when there was complete FOMO in those markets.
Frenzy. Yeah, there's definitely fewer buyers around. House sales over the past 12 months down, pretty much everywhere around regional Australia. The biggest drop in Southern Highlands and Shoalhaven, sales were down by a third. And the time to sell is about twice as long as it was a year ago. I think Eliza Owen here at CoreLogic, just to wrap up on this one, Chris, said the easiest way to characterize the markets most impacted is the price point. So some of the higher value properties in regional Australia have been impacted by the increase in interest rates. But she said the good news for sellers is that these markets do appear to have passed through the depths of the downswing. So that's interesting. Maybe some signs of things stabilizing a little bit. But yeah, definitely I mean, this is not completely unexpected. We had such a big run up in prices in a lot of regional markets over a 2 or 3 year period that some correction, not at all unexpected. And we're certainly seeing that in parts of the Sunshine Coast, which I've seen firsthand. So we'll keep on watching that. So, Chris, second story this week. So the ABS put out a sort of a new experimental data series where they were taking a look at there's a range of factors right into dwellings, but they found that based on electricity use, only around 1.3% of dwellings appear to be unused of late, according to their best analysis of electricity usage. And I thought that was pretty interesting because that's a heck of a lot different from what we often hear about on census night when people say, well, there's nearly 10% of dwellings or 1 million empty dwellings. But I know from first-hand experience, because I've missed 2 of the past 3 censuses. One year, I think I was on a campsite. Another year, I was overseas. And that doesn't necessarily reflect the utilization of the stock. Now, this figure, 1.3%, looks a lot more like what we're seeing in the rental markets. And I do think, though, we still probably do have a lot more holiday homes and Airbnb properties than we did a decade ago. But it's clearly not the sort of 10% of empty dwellings that we often hear people talking about, especially after the census.
Yeah, I mean, it's even 1.3%, still a lot of properties, but it's nowhere near the, if we say there's 11 million dwellings, I think there is now, right? So 1.3% on that, it's like 140,000 properties versus when we thought it was 10%, which would be over 1 million properties, which, defies belief really that high, right? You don't see that many properties that are, boarded up or, no one's living in them. But I do think if there's, even if they could decrease that underutilization, to, 0.5%, you've created 80,000 more rental properties, or you've created 80,000 more dwellings that people could move out of rental properties to move into. And so I think this is a really, and there could be some type of vacancy tax. So if you're only hitting 1% of landlords here, in this situation, it's not a big political thing. So if there is a cost, if you aren't using any electricity, if it's not used, and that encourages people to make use of that land, right? It makes people not just let it sit in a land bank and just know that capital growth is doing all the heavy lifting. They don't need to renovate it. They don't need to enter the rental market or build on it. They could just sit on the capital growth. So if there was an additional tax on those, I think that's something that may happen in the future, right? Because there's any solution to creating more dwellings immediately is a good move.
I think one of the things that isn't maybe talked about enough, Chris, is the impact of Airbnb. So you might notice from the different backdrop this week, I'm actually in an Airbnb property this week, just traveling around a bit with the family. I think I recounted once before, I stayed in Sydney last year at a tower block down at McMahon's Point there. Beautiful spot overlooking the Opera House and everything else. But I would say from what I discussed with some other people in the block, something like about, maybe 80 or 90% of the units in the block were on Airbnb. They weren't really in the best of nick. Probably didn't work that well as long-term rentals, but on Airbnb, generating fantastic returns. I've been hearing from various people in the Northern Territory getting Airbnb yields of around 10%. Just on small properties up there. Cairns is another place, and there's actually plenty of regional markets where people are getting good Airbnb returns. I've actually spoken to some portfolio investors who had no intention of getting into Airbnb when they started out, but maybe with a few units in places like Queensland suddenly generating returns from short stay lets, and it's effectively funded their retirement. So there's definitely there's a lot of this going on, and it's obviously going to have an impact on rental markets, and it's probably sucked some of the supply out of the long-term rental market. So you got any thoughts on Airbnb, Chris? I guess there's always the risk of regulatory changes, but would you ever look at it as an investment?
Absolutely. I think it's definitely something to consider. I guess you've got to be very careful where you do it. I mean, I can't be a hypocrite here, right? I use Airbnb all the time. I use it up in the Gold Coast. I've got 50 plus reviews on Airbnb, so it shows how much that we use it, right? And a lot of people don't even leave reviews for the guests. they want it as the person renting it out. But I think Airbnb is a great thing. I think it just gives people flexibility, ability, especially with families, to move around. Great for tourism, etc. Obviously, there's a negative to all this, is that it takes housing or property supply out of the rental market. But it's hard to say that the landlord can't use their property to the best, option, right? You can't say to them, oh, you have to put it on the rental market. You can't consider Airbnb. I think that's pretty harsh. I do think there's certain micro markets where, the pressure, Airbnb is just taking too much of the rental supply. So it's pushing out key workers. It's creating, because it is a tourism hotspot. People, there's rental crisis. People are homeless and things like that. So, if you look at Noosa, I think there's some real restrictions on that. There has been a lot of not that great regulation around it, etc. So, the quality of Airbnb and, protecting the issues with insurance and things like that. So I do think it needs to be strictly regulated, but I also think that it should be part of our market now. And I think whether you should consider it as an investment, you could do well on yield, but yield's great. Maybe when you're retired and you don't need capital growth and you just want income and you're on low tax rates because you're not working. So, yield's great. But if you're looking to build wealth, it's very hard to make much money on yield because you pay 40-50% tax on that. And, and then you got to pay mortgages and maintenance and things like that. And yield sometimes misunderstood. I think especially with Airbnbs, it might look great. You're getting $100,000 a year of income, but once you take out all the expenses and paying Airbnb and cleaning and maintenance, which may be a bit higher, how much are you really making about over the long-term rental market? And how guaranteed is that? It's if something changes in the market, plus you've got to furnish it and things like that. So I think people can get too excited when they look at the actual net yield and the net amount they're making. Is it much more than the long-term rental market and all the hassle? But the dream scenario is, could you get an amazing capital growth asset, but also get an amazing yield on it? If that yield comes through Airbnb, why wouldn't you consider it? If you think about a house up in Byron, for example, or or a really bigger, older apartment that suits families, but you could also rent it on Airbnb. So it gets great capital growth, but it also great yield. So absolutely consider it, but you'd want it to stack up on its own 2 feet from a capital growth point of view and in the long-term rental market versus just Airbnb, because otherwise I don't think yield's good enough.
Yeah, it's a really good summary. I think a good rule of thumb in investing is that a high yield usually represents either a risk or a cost of some description or other. So if you looked at, for example, a high yield ETF, you'd generally find that the yield might be higher, but the capital growth over the decade would be quite a lot lower than some of the other ETFs. Or I think I've seen in property before, over in the UK, these houses have multiple occupancy and they sort of 12% yields and 13% yields. But the thing is, that does come at a cost. It's practically a full-time job managing all the tenants and the changeover and the non-payments and the repairs. And, as you said, if once you net out all the costs, well, maybe that, that 10% yield is suddenly 6 or 7. And, sometimes I think you certainly in commercial, we're saying you can get net yields of 6 to 8%, but sometimes that does come at a cost in terms of capital growth, especially if you're just buying an industrial shed that's miles out from anywhere. It's not to say it can't be done. As you said, I think some of those coastal markets, people have seen some spectacular results. But I think sometimes people can get a bit misled by focusing just on the yield, and that's what leads people into sometimes mining towns or one industry towns, and that's where people really can come unstuck, especially in a liquid asset like a property investment. Interesting stuff nonetheless, but certainly there's not so many vacant or unused dwellings as people might previously have thought. So Christy, the final story that sort of grabbed the eye this week, lending buffers. So as we know, when the cash rate target was reduced to the 0 lower bound, the regulator APRA introduced a 3 percentage points lending assessment buffer. So in plain English, if you're an investor who's going to borrow, let's say, a 6% mortgage rate, then you will be assessed or stress tested to see whether you can comfortably make the mortgage repayments in the event of a 9% mortgage rate, which doesn't really make sense now that we're at the peak of the interest rate cycle. And I think, there's a tug of war going on here. We had the CEO of ANZ, Shane Elliott. He said, well, the settings are wrong. This is locking first home buyers out of the market. We're making life very tough for small business owners who want to borrow. And we're basically making banks just the purview of the wealthy. Also on a similar vein, actually, it was the CEO of Stockland, Tarun Gupta, said the same thing. He said first-time buyers are crawling across their website. People are looking at display homes, but they just can't get finance because they're having to stress test people at 9 or 10% mortgage rates, which just aren't going to transpire realistically. A regular guest we've had on the podcast, Peter Tulip, he said this week, former RBA governor, now with the CIS, he said this is paternalistic and unnecessary. But then, interestingly, APRA actually launched their corporate plan this week, and John Lonsdale said, well, there's no plans to change the serviceability buffer, although it's under a rolling review. But he said generally credit quality is good, arrears are sort of under control, and they're not really, well, it doesn't seem to be any urgency to change anything from APRA's side. But do you think there might be just more pressure coming from the property industry and the property lobby to take the buffer back to the sort of a more normal 2% level?
Yeah, it's going to be interesting in this one because, we've had a couple of months of rate, pauses, I guess. Are we at the top of the cycle now or not? I think that's something that's maybe still up for debate, whether there's one or two more to come. I think it'd be a bit sort of, I don't know, I think it's a bit dangerous playing this interest rate with the top of the cycle. I think we've been taught a lesson a few times, but things are looking likely, right? Even the inflation data yesterday, and the market's potentially not even pricing another rate increase. They're, starting to talk about cuts. And that's when I think the real pressure on APRA will build. So if we've got 3 or 4 more months of rate pauses, right, and we go into sort of early next year and inflation's looking really strong, and the conversation in the media will go, and I feel it's already happening, to be honest. Are we going to get more rate increases? No. Okay, well, when are we getting rate cuts? That'll be the flavor of all the news articles, and the pressure will start to build on APRA, because if rate cuts are coming, why are you assessing people 3% above the current rate to protect them if rates go up? In particular, because it went up from 2.5 to 3% in 2021 because the market was getting overheated. So you'd have to argue that the market's, that at least that 0.5% deserves to be given back. But whether it goes down to 2%, that'd be a 10% increase in borrowing capacity. If that also aligns with a 1% cut in rates, because it won't be, a 25 basis point cut and that's it. There'll probably be a few cuts. That would be another 10% increase in borrowing capacity. Stage 3 tax cuts come through July in 2024, I believe. And so that's quite a lot of, particularly if you're on the higher, incomes, that's quite a lot of tax back in your pocket, which increases your borrowing capacity. So if you've got those 3 things, you could see quite a significant jump in borrowing capacities at a time when borrowers are also willing to use that borrowing capacity because rates are going down. That's when I think it's going to happen. But all I think it's going to do is add more fuel to the fire. And that's what I think APRA's a bit nervous about, is the property market showing resilience. It's being strong. Do I really need to throw more fuel on the fire here when the fundamentals are looking great? But when you start to get pressure, first-time buyers can't come out. People can't refinance. Stockland, who have sort of said, it's hurting first-time buyers, that's because they can't reduce the lot size of their, land any further. We're already down to 300 square meters, and it was 500. So the only way they can, they can't reduce their prices any further, really. So they need borrowers to have more money to buy their lots, I guess. So, I do think this is going to be a big story, and the pressure could get too big for APRA once rates stay paused for some time.
I think there's definitely this sort of pro-cyclical versus counter-cyclical thing here. And I guess when you've got inflation that's run far above target on all of the supply issues and supply chain pressures that we've seen, I suppose, APRA sort of works with the RBA as part of the Council of Financial Regulators. And I think actually slowing down lending is part of the story, I guess, for sort of bringing or slowing the economy, bringing inflation back down, and maybe that's a part of why they've maintained the buffer for some time. But as you say, I mean, at some point this doesn't make any sense. And I mean, this is also, we've got a shortage of housing. Almost every week there's a news article in Southeast Queensland with the Premier posting, we've just acquired or we just built sort of 8 new dwellings in Gympie, which is, basically dongers, and you're thinking, well, this, new home sales are very, very low. And, at some point this is actually becoming counterproductive. For sure. You want to remove risk from the system, but as Peter Tulip said, why are we stress testing people for mortgage rates they're never going to pay? It's just locking first home buyers, potential investors out of the market. It's not really helping. But as you said, maybe until we've actually seen sort of confirmation that the next move in interest rates is no longer going to be up, then, well, maybe the buffer will just stay in place for as long as that proves to be the case, and then the pressure might build next year in 2024. And I did see one of the banks now just applying a 1% buffer for refinancing. That was, so I named the institution, but I do think there's potential for some of the non-banks to push the envelope a bit harder, potentially not regulated in quite the same way as the deposit-taking institutions. I think certainly one or two of the non-bank lenders are going after a few of the big fours, sort of conforming customers with very competitive mortgage rates and making those applications a bit easier. So sometimes the risks, yes, you might remove the risk from the big four banks, but the risks might just go off elsewhere. And in any case, is removing all of the risk from the system the right way to go? Not necessarily. So definitely something to watch as we go into 2024, because if the inflation figures do come back down towards target, then why have we got this exceptionally large lending assessment buffer, which we've never seen before, nothing as wide as this, and that could sort of fuel housing market recovery as borrowing capacities recover. So I think that's it for our main 3 stories this week. Chris, what have you got on over the next week or two?
Yeah, I think the final point on that, I think the issue is going to be for people who need to stretch to their maximum, right, who haven't got enough, a lot of first home buyers, who haven't got enough capacity at current prices. It's already really tight, right? They wish they had more borrowing capacity. We've absolutely got lots of those clients who are backing themselves financially and say, yeah, I can borrow more than what a bank would lend me. I know I can afford it on repayments. I know my income's going to go up. But so that then they want to enter certain markets, and it's just potentially not enough money. And the issue you're going to have is that if you do start to see this belief that rates are going to start to go down, is the people who have got a lot of capacity up their sleeve, who typically don't want to stretch, if they then wanting to start entering the market and start stretching because they go, well, yeah, I know rates are going down. I know I don't really want to. I've got heaps of capacity, but I will because I'm going to get a better asset. So you're just really going to, whereas that borrower who's really tight right now won't be able to stretch because they already are at their maximum until you get rate cuts, until APRA step in. And my worry is that, the prices are going to run on them. And then when they get that borrowing capacity, they're going to have to pay high prices anyway. And that's just going to be, late to the party almost. So I do think it's going to really hurt a lot of the first home buyers who, have got really tight capacities, want to enter the market, but just can't enter at the point they want because capacity is just so tight. So, not much happening here, Pete, in the next week or two. I've had a few holidays in August and it's head down, bum up now for a good run.
Got to catch up on the old inbox. And I'll be flying long haul because I've got to get back for the Rask Roadshow in the next couple of weeks. And as I mentioned, 22nd of September on the Friday in the afternoon, we're doing a little half-day workshop property masterclass. So if you want to come and see me and Chris, shoot me an email. We've got a few spare tickets. So first come, first served. And looking forward to getting in front of a live audience again, Chris. It's been a little while. So it's usually good fun and we get a lot done, an intensive half-day workshop. So look forward to seeing you there.
Awesome.
And as always, if you've got any questions that you want us or anything you want us to cover in the show, do drop us a link in the show notes. You can catch me at Pete Wargent Blogspot. That's my daily blog, or at Pete Wargent on Twitter. And Chris, if people want to get in contact with you over at Blusk, I guess where's the best place to go? There's a link in the notes, I think.
Yeah, link in the show notes. Just check us out there. Absolutely, we'd love to run some numbers for you and help you think through your decisions. But yeah, I think looking forward to this next week already. To be honest, Pete, there's intergenerational reports come out. There's been a lot of new things we couldn't even cover today, so we've already got our 3 stories lined up. So yeah, thanks for listening, and I wish everyone a great Sunday.
Never any shortage of things to chat about. Cheers, Chris. Talk soon.